Good afternoon, everyone. So, a big round of applause for all the winners first, because they deserve it. So, so I will be covering in this session my experience with passive funds. So, we will be covering two MFDs who will share their success stories on how they have grown business through passives. So, I would first like to invite Mr. Kaushik Deva of Kredere Wealth. So Kaushik is a CA turned MFD, and he has over 20 years of experience in the financial services industry. And Kaushik started in 2015, but currently he manages close to 6,000 crores of assets across all asset classes and 3,000 crore in mutual funds. Welcome, Kaushik.
Thank you.
So Kaushik, you have over 30% of your assets coming from passive funds. So what got you interested in passives?
I'll break it up into two parts, fixed income and equity. Post the... sorry. I'll break it up into two parts, fixed income and equity in the passive side. Post the ILFS debacle, we found the top rated papers defaulting. We found a huge meltdown in the fixed income space. And the segment we are in the HNI and the ultra HNI segment, where they've already created wealth. The whole first objective was to preserve the wealth. So we realized instead of preserving the wealth, forget about preserving, we were destroying wealth. So we thought a lot and we debated a lot internally. And then in came, initially Bharat Bond, and then thanks to all the AMCs, the target maturity funds, which straddled across all kinds of maturities, all kinds of securities, whether it's GSEC, SDLs, PSUs, and a combination of them. And we also realized the yields had also gone up by 2.5% in that period. So what better way to enter into a product which is giving you the highest credit rating? It's sovereign credit. It's giving you attractive yields. You're locking in that attractive spreads, and you're locking in for long term with the option that if you want to exit, you can exit after 3 years with long-term capital gains tax, else carry on depending on how the situation is. We hit the road with these target maturity funds, and we raised, I think, 1,500 crores in a period of 3 months just by positioning target maturity funds. And obviously, the big advantage was fixed income. You can't go with a fixed income fund with a high expense ratio. It takes away all the returns. So being low cost, the difference in the brokerage was only 20 basis points. That didn't deter the people then for going in for passive debt funds. So that is fixed income. So now come to equity. Now, once we sold the fixed income space, the tax rules changed from March 23. What do? We started looking into equity. We had, over the last 30 years, all of you would have experienced, our experience shows that no fund manager is able to sustain his performance for long periods of time in equity. There will be periods of overperformance, underperformance, elevated performance, but guess what? Everything always reverts to mean in time to come. And the Nifty index is a very strong index. To beat the index itself is a challenging task. So we looked internationally. Internationally, we found that the S&P index and the NASDAQ, nobody's been able to beat the NASDAQ index by any stretch of imagination. And S&P, also no active fund, unfortunately, has been able to beat the S&P 500 index. Just 2 to 3%, and that too with a narrow margin. So we started selling, thanks Motilal had that started with the NASDAQ fund. We started selling the NASDAQ ETF. We had already started selling it from before. And it gave handsome returns. And that time, again, the tax was in our, benefit was in our favor. So we again went back to the drawing board and did a lot of analysis. And we saw that while the core portfolio should be made of something which is sustainable, long-term, in line with the economy, with the growth, what best the way to do it than index funds? Again, we went to the market, we went with index funds. It helps us to get entry into the client. It helps us to make him think that we're not here to just sell products. We had to sell solutions. We had to give them the data as to how. If you see the last 20 years, we all know nominal GDP growth is 12%, earning growth is 12%, census has given 12%. So it's a no. So while we can't look at the review mirror and say which fund is good, we can at least say on this basis how to proceed with investing in equity and get index-linked returns.
When did you start selling passives? You started in 2015, the distribution business.
So obviously we didn't sell passives in 2015. The 2018 was the first time we started looking at passives more actively because of the fixed income debacle which happened. So what do we do next?
Yes.
So then obviously Bharat Bond came, but Bharat Bond was one. Bharat Bond only had PSUs. It had only one particular maturity. Then when the target maturity funds came, we went to 2035, 2037, 2043. So that helped us to lock in yields at attractive spreads. So maybe around 2018, 2019 onwards, we did fixed income. And equity we started doing 1.5 years back.
Okay. So within passives, while majority of your assets in index, you also distribute ETFs. So how do you decide where to allocate money, ETFs or index?
Now, I would say majority of my assets are index funds. They're not ETFs. ETF is only for those cases where you want to do lump sum investments. If you want to do SIP, STP, staggered investment, right? And if you want to sort of spread it over a period of time, then index fund is better than ETFs. But if you have lump sum money and want to do plain vanilla index funds, Nifty index, yes, ETF makes sense. And ETF also makes sense if you want to time the market. If markets were down last 3 days, when markets fell by 2.5% and 2 days back, we went and bought ETFs at that point of time. And obviously that ETFs are making money. So it's more opportunistic than otherwise.
Okay. So according to you, where does passives make more sense compared to active?
With all due respect to the fund managers, they're unable to maintain. See, they cannot project the future. You can only look at the past. And there's so many factors of momentum, volatility, quality, growth, etc., which come into play. It's very difficult for you to get the ideal portfolio at all points of time. And passive, we realize, let's just show it to the clients as a core holding of theirs, whether it's SIP, STP, or 25-30% of the holdings. So we said, look, we don't want any high deviation from the benchmark. All the time then we are justifying the deviation from the benchmark. So, and at any point of time, we have seen some schemes are doing on the top quartile, someone mid quartile, someone low quartile, and otherwise someone top quartile, then again in low quartile, and then again they take time to pick up. And if you enter the scheme which is in the high quartile, which generally we do, and then we tend to end up getting low quartile returns. So we decided that this can't sustain our business or can't sustain, and we can't even make money for clients. They get fatigued. They get fatigued with you, and they tend to move on. They tend to change advisors. They tend to look at other alternates. So that's why we decided passives makes much more sense in terms of stability, consistency, and giving a sense of comfort and core holdings for the clients with lower costs.
Any specific fund category where you have completely replaced active into passive?
So in the large and mid-cap space, where the information asymmetry is not so much, we have gone whole hog in replacing all our allocation to large and mid with index funds and smart beta funds.
Okay. So, Kaushik, you advocate smart beta funds. So, does this fund really work? What is your take on this?
It's worked wonders for us. It has helped us make huge entries with very large families who were either. So this also helped us in making entries with families who were doing direct equity. We were able to show them why a fund, a momentum, or any smart beta fund is able to generate better, sustained, and outperform the direct equity holdings or the core holdings. All of them are sitting with HDFC Bank, Kotak Bank, Hindustan Lever. They're sitting with Asian Paints and Nestle's and Bergers, and thinking that they are blue chip stocks. And then they realized, look, this is what these and these are good portfolios, top 100 stocks, 150 stocks, 200 stocks, well researched, with a particular factors in play, which internationally also has been a proven fact. And And if you do backtesting from till 2005, when NSE gives data of 2005, we did all kinds of scenarios of drawdowns, rallies, a downside, upside capture ratio. And we were able to show the clients with data how the smart beta funds have outperformed active funds, outperformed the equity portfolio. We took all the equity portfolio of the clients. We showed the return the last 1, 3, 5, 10 years vis-a-vis the smart beta funds. And guess what? The smart beta funds were consistently and handsomely outperforming the direct equity portfolio also.
So Kaushik, you offer your services to ultra HNIs as well, right? Why do you think that HNIs prefer passives over active funds?
See, HNIs are very cost sensitive, first and foremost. Second, they have already created wealth for themselves. They want something to be, they want holdings to be core. They want holdings to remain for, and now they have gone through the cycles of maturity of the various cycles of the markets and understand that there will be volatility. So they are willing to stomach the volatility and go in for these passive funds, which are which are sector agnostic, which are fund manager agnostic, which are scheme agnostic, which are regulatory agnostic. The changes in regulation landscape or large, mid, flexi. So that none of that comes into play when these are passive index funds. So the realization is dawning on them. It's a slow process, but it has picked up well, and we are very confident of making deep inroads in the ultra HNI space through this category.
And what about retail investor? Do they also demand passive funds?
No. Retail investor is not yet that educated. It's not yet been so penetrated for them to understand.
Okay. So most MFDs, usually stay away from passive funds because they feel they are not economically viable for them. So what is your view on this?
If you have to remain in the game for the long term, you cannot shy away from passives. You're making a big error. So, because that's the way forward. That's the way forward internationally. It's proven fact. That's the way forward in India. You have yourselves experienced change in fund managers, change in regulatory landscape, top quartile, bottom quartile returns. Nifty index itself is such a powerful tool to beat. Because they take the top 50 companies on a consistent basis every 6 months. Then top 100 companies and top 200 companies, they are automatically filtering out all the weed and all the negative aspects and taking all the positive aspects. So if you want to be long-term in this business, you want to sustain your clients' AUM, you want to make inroads into your clients' wallet share, the volume itself will take care of your difference in your distribution income.
So while in index you get some margins, but ETF, do not pay anything to distributor. So in such a scenario, why should MFDs look at ETFs?
There's no gain without pain, So if you don't go and win the confidence of the client, you don't go and get his wallet share, you don't get his years, you cannot make any further inroads. So today, if an ETF generally makes sense, listen, end of the day, we are here for our clients. If our clients make money, we make money. They will help us make money. We are very clear with that philosophy. So if ETF makes sense, even we have low cost or zero earnings, we have done it in the past, and it has helped us to make inroads into the client's wallet share, client's confidence, client's trust, and build a long-term relationship. And those very clients have come back to us with that full portfolio.
Okay. So one last question, Kaushik. So there are many AMCs here. So how can AMCs make passive funds more attractive for distributors?
Firstly, I thank all the AMCs for taking the initiatives of doing so many kinds of variables on the target. We saw all the rewards on the target maturity funds, schemes, on the index funds. They must keep looking for factors.
Sure.
Be it volatility, alpha, momentum, growth, or a combination of them, which can give superior returns on a consistent basis to the investors. And then go ahead and educate the MFDs very aggressively on this basis and let them know that how this is a very small market. Today, the market cap of BSE is 400 lakh crores. So the deposit base is 200 lakh crores. There's so much money to be tapped. There's so much money to be there's waiting for coming into the equity or fixed income, largely equity, I would say. So it's very important that they are able to engineer, understand, construct, and educate and disseminate.
Thank you so much, Kaushik, for your valuable time and inputs. A huge round of applause for Kaushik.
Thank you.